Good to be with you, Merlin. My name is Hugh Agro. I'm the president and CEO of Revival Gold. We're advancing the Beartrack-Arnett Gold Project in Idaho in the western United States, now 4 million ounces of gold, moving towards a PFS on this brownfield site. With me and with you, Merlin, is Tim Warman. Tim became a director of Revival Gold just recently, has hot off the success of Fiore Gold, bringing that to operation and ultimately the sale of the company. So very relevant to the task at Revival Gold. But we go back a lot further than that. Of course, Tim was involved with the discovery of Fruta del Norte in Ecuador and many other big discoveries as a geologist by training and a wonderful gentleman in the business. We're happy to be with you, Merlin, and chat more about Revival Gold.
Hugh, Tim, very nice to have you on this interview. And Hugh, thank you for the introduction. Tim, nice to meet you. Today, we're going to take a slightly different approach. Normally in my interviews, I talk at the project level, but when I was talking with Matt recently, we felt that there was a kind of a gap in some of the questions that both he and I were asking companies. And so this is the inaugural validation interview for Crux, and we're honored to have Revival Gold as the first company. Really, what we felt we were missing in the conversation was kind of an analysis of the value blocks in any given company, whether it's in copper or in gold or whatever the commodity, and how the company sees that growth profile. Going from an exploration company up that Lassonde curve, and what can investors expect. What can directors expect in terms of the value per share, and how that fits into the broader macro cycle, and how that fits into the broader kind of development cycle. So, there's lots to unpack here, and thank you for being so willing to discuss that with me. Long preamble from me, sorry about that. But let's just get the kind of the building blocks there. Just remind me of what the market capitalization is of the company, the resource base, and how you view yourself on an EV per ounce basis.
Sure. So market cap today, about 50 million Canadian dollars, with about 7 million of cash, last reported cash balance, a resource at 4 million ounces of gold, all in the Western US. And I could point you to a slide that perhaps depicts the valuation, the relative valuation, if you'd like, Merlin. Just give me a moment.
Yeah. Let's do that. And all of this is in the context of a difficult 2 years. I mean, if you look at most gold companies, they peaked in the middle of 2020, and we've pretty much been on a 2-year beating since then.
That is correct. It's been a tough past few years. So there's some great value in the sector for investors. We think that value will be brought to fruition, especially as we think about what's happening in the industry, the lack of growth projects to feed future demand by majors and by intermediates, and I think that's where we can outdo the metal itself. And I just try to pull up this slide for you here. And we can look at what some of that means. So here we have relative value in the sector, some of our peers. These are figures that we've gathered from the market, from company information. And what I'm trying to show here is to answer your question directly, market cap per ounce, EV market cap per ounce of resource on the left axis, relative to the number of companies here, which we would view as our peer companies, and then looking also at grade, because grade is a big factor in the value of a deposit, the economics of deposit. Here's Revival Gold here. I mentioned to you we're about $40 or $50 million market cap, 4 million ounces of gold with 7 million of cash. So our current valuation per ounce in the market is about $8 an ounce US. Our grade sits well above a gram a ton, And you can see we compare very favorably with some of our peers like Marathon or Perpetua or O3 Mining. Much better in terms of grade than some of our other peers in the space. And yet our valuation is pretty compelling. Compared to our peers, which are trading at $31 an ounce on average, we're trading at $8 an ounce on average. Compared to the average takeover price of companies in the space recently from RBC, $65 an ounce, quite a bit of upside here. On the right side of the page, we've described some of the recent premium deals. Tim can speak to this one here, which is a pretty interesting comparable for Revival Gold. But here you can see, from $44 to $100 an ounce in recent premium deals for assets. And of course, every asset, every deposit has its own attributes that mean, one thing or another in terms of value ultimately. But certainly on grade, we're in very good shape at Revival Gold, and the street research reflects that in terms of target prices for the company's shares.
Thank you. Goodness, Hugh, there's a lot to unpack in that. It's a very data-rich slide. Can I just ask, the Marathon Gold on the right-hand side, is that Marathon who are operating in Newfoundland with the Valentine
Correct.
project? Okay, thank you. And so you've combined just so I understand it correctly, you've combined your indicated resource to you added up the total indicated with the total inferred resource, because your inferred's at 1.3 grams and your indicated is at just 1.01 grams. So is that the combined grade or the weighted average grade there?
Correct. It's total ounces in the ground, measured, indicated, and inferred.
And how did you select that peer group? Is that because it's a difficult thing putting a peer group together, and it has to tell a picture. So what was the background to that peer group?
Yeah, so we started firstly with assets, companies with projects in our similar geography. So we're talking about the United States and Canada for these companies. And then we looked at projects in the exploration development phase. Now, some of these are further along and hence they have higher valuation. You mentioned Marathon, now with aspects of permitting in place, a great team there, a great project in a great location, and good grade, trading at a premium valuation compared to this peer set. On the other hand, you've got some others here who are not quite as far as long. Some of these just at an exploration stage. We've got at Revival Gold, we're kind of halfway in between. We've got a brownfield site, so we've got a head start on permitting, and we've also got a PEA on about a third of our ounces. So we're somewhere in between the peer set here, but mostly exploration development companies, North American based, and that's where we sort of gathered this group from.
So I've over the years I've spent quite a lot of time looking at EV per ounce equivalent. It's a crude measure, but it is some form of measure. And as you said, there are always deposit specific or company specific idiosyncrasies that can affect the valuation. That peer average, so it's sourced from public company filings as at September. Is that September 2021?
It's just in the last month or two, actually. So share price data is probably about a week or two old. The historical average M&A data point comes from RBC Capital. I believe that's dated July. The peer average would be just the peer average on this page. I think if you were to look at a broader set of peers, you might see something between $25 and $45 an ounce. But this is just this peer set here, recent data.
What that shows, I think, is that some of the more advanced projects have got a significantly higher rating, and that the companies which are at the earliest stage are trading around that 20 or below range, and you could probably have added in free Freeman Gold and a kind of a bunch of others, which have shown that the explorers at the moment are suffering. Which I see that there are so many explorers which are having this kind of punitive valuation given to them. People have just sold them off because they can't see where the catalysts are coming from, and that the companies which are further down the road with their more advanced studies and the as you said, kind of Marathon's got some of the key permitting in place. They're the ones that are actually pulling your average up, even though that it's still below the long-term average. Yeah, perhaps could you drop this slide? I'd love to kind of get you and Tim kind of more kind of front and center.
Yeah, absolutely. I just want to show you one point that illustrates or reinforces what you've said, which is look at the premiums for these three companies here. Corvus undeveloped, 22% premium for that sale. Fiore, on the other end of the spectrum, 44% for an operating mine. And in between, you have GSV, Gold Standard Ventures, recently transacted a feasibility stage project somewhere in between. And so that kind of illustrates and underscores your point that as we move up the development path and de-risk these assets, they become more valuable to acquirers and investors alike. I want to come back to that theme when we talk about the catalysts at Revival Gold and speak to that.
Thank you, Hugh. That's a key point. Tim, can I bring you into the conversation at this stage? What was your approach with Fiore? And I know that luck plays a part, but I'm sure there's some other planning as well that goes in there.
Yeah, so Fiore, I think was an interesting story because we were a small Nevada producer. And if you looked at the kind of peer group of small producers that had gone into production, within that kind of time frame that we went into it, we sort of stood out in that we were the only ones who actually made any money, on an operating basis. And I think that made us attractive. But one of the things that Hugh was saying, and it goes back to this theme of M&A and really being the future, is that you need to get bigger to grow. And I think companies see quality projects in good jurisdictions, and that's going to become very attractive to them. That's why I think Fiore was acquired by Calibre. They were looking to get out of their single jurisdiction risk and diversify on a country basis. I think they were looking for a solid operating team, and really I think we fit nicely in with their existing producing portfolio. So that transaction made a lot of sense. But I think one of the keys there is that it's the scarcity of good projects. There are I think that's one of the things that attracted me to Revival and why I wanted to join the board, was because I really like the team and I really like the deposit and I like the jurisdiction.
Good to get the endorsement on Revival. What was the scale of production? What was the kind of the quantum that you were producing on an annual basis at Fiore?
At Fiore, it was about 40,000 ounces a year from our single mine, and then we had a development project next door, which was going to, together the two of them would have kicked up over about 100,000 ounces a year. So that was our growth plan. We had tried actually to grow the company by acquisitions, and one of the things we found during sort of 2.5, 3 years of some pretty intense due diligence work is that projects, even the ones that look good on surface, once you sign an NDA and get sort of behind the curtain, you see a lot of skeletons in the closet on these projects. So I think that's just goes back to the kind of idea that there's a scarcity of decent projects out there.
How can you communicate that you've got a good project to the market? What do you see as the kind of the key aspects? Is it grade? Is it taking it through to the measured category? Is it advancing all your engineering studies? Do you have to take it through those gating posts of PEA pre-feasibility study? But because I've seen some pretty bad studies on at those levels. So,
yeah.
What do you consider to be kind of key elements?
Yeah, I mean, I think as you say, not all studies are created equal. When we did our PEAs and pre-feasibility studies, we at Fiore always tried to be very realistic and conservative. We didn't put in numbers that were based on hope. We put in numbers that were based on our own experience operating the existing mine at Pan. But I think, obviously there's that de-risking is going to add value, which I think is very much what Revival's trying to do. Push it methodically through the studies. Don't try to take shortcuts. Do the work that's needed. Getting quality consultants to do the work so that you're not using some mom and pop shop that no one's ever heard of that is going to give you the numbers you want rather than the real numbers. So yeah, I think it's key to steadily push forward and de-risk the project like that, and not just from a technical point of view, but from a community point of view, from a permitting point of view, from an environmental point of view. All those things are key to adding value. And again, I think that's what Hugh and his team are doing a great job of.
I sometimes see that you go through that de-risking and it doesn't affect the share price. It doesn't affect, and then there's some intangible moment where the market goes, "Oh, I get this," and then you just get the elastic breaks, and it suddenly just goes.
It's absolutely true, and we haven't hit that moment yet, but it will come, and I think sometimes it just needs to be a sort of track record of management telling the market this is what to expect, and then delivering on those milestones. And I think that's one of the key things. The projects that never seem to get any tractions are the ones that are always promising and then under delivering or not delivering, and then pushing those promises continually into the future. So yeah, it is key. It's always a bit intangible. When do you hit that moment that the market suddenly wakes up and says, hang on, this is a real project here? And sometimes it's not the market at all. Sometimes it's another company that sees it before the market does.
Yes. Yeah. And that's when you get the M&A surprising the market. And it's quite often when sentiment is going down, and then you actually see that the bigger beasts have done their due diligence and they make their move. Yeah,
absolutely.
Hugh, coming back to you, in terms of the development plan for Revival, you've got a lot of exploration on the go at the moment, but you're also looking at restarting a heap leach project, which is partially completed with a PEA, but you're working to a new study. Can you just remind me of the timetable on that?
Sure. We're working towards a PFS. We completed the PEA in late 2020. Encompassed about a third of the resource at the time, and we're currently drilling on more of that resource to include it in the PFS, and we'll get a PFS out. We are, and then we'll move to feasibility and plan of operations. Our intention is to be in a construction mode by 2024. And I'll just quickly share with the screen here and show you our site and why we've got such an advantage here. You can see we've got an ADR facility, gold production facility on site, power to the site, active 69 kVA line, core logging storage facility here, leach and solution pond. So it's not going to take us the same amount of certainly not the same amount of capital and not the same amount of time and effort to get this back into production. But it brings up another point, which both of you have touched on, which is you need to be able to get to scale. And this PEA, contemplated 72,000 ounces a year of production, about the same sort of order of magnitude of Fiore plus or minus. But what we've got with this deposit is the opportunity to build scale and something that will have a subsequent follow-on phases, organic follow-on phases that will allow us to get up, over 150, over 200,000 ounces a year, and that's why I think this project is unique from a marketing point of view and from an investor interest, corporate interest point of view. Is we've got a first phase heap leach, relatively straightforward to put into operation, targeting for 24 timeframe to be in construction, and then follow-on phases, which will take us up, upwards over 200,000 ounces a year, and that's pretty unique in the space.
much to unpack there. There are two things I want to talk about. One is the heap leach, and one is the kind of the future growth. The heap leach, envisaging around 70,000 ounces, 72,000 ounces per annum of production. That's going to come from both sides of your properties. Some open pits along the I'm going to get this wrong. The Beartrack trend, and then the kind of single larger, kind of more continuous, shallower pit from it's at the Beartrack side. I always get this too confused. Sorry, I should have it written down in front of me. Stickers. As I understood it, you were doing some kind of expanding the edges of the pit around Beartrack, around Haidee and some of those other areas. And that exploration is going to be incorporated into a kind of an open pittable resource, isn't it?
That's correct. Yeah. So this is the cross section through the main Haidee pit that you're talking about. You can see the resource outline. We just came out with this resource in May. But look at this, drill holes outside of the resource footprint, lone drill holes, and outside of the block model, which are a function of the fact we just don't have enough drilling in there. So an up dip of the existing resource, where we've got a soil geochem anomaly, opportunity to lower strip ratio. So this is illustrative of the kind of exploration opportunities and the opportunities to add value to the deposit this year. We're currently drilling with 2 drill rigs in the Joss area on the main Beartrack trend, and we'll move those rigs up to this Haidee area and be adding to the overall picture here as we move towards a PFS.
Because I think that's going to be crucial, what you've just been talking about. To get that near term valuation kind of kicker on the share price. So I know you've got 4 million ounces. It's quite complex and it's quite hard to know when to schedule it. And you've spoken about the long-term growth potential. But if you can demonstrate you've got a pre-feasibility study, which has got an NPV, which is reduced because you've got the CapEx saving because you've got the existing infrastructure. So if you can present an NPV at a relatively high level of engineering, which gives out a good number, then you can talk about not just EV per ounce, but also discount to NPV, which is another powerful measure.
Yeah, and absolutely. I think, as you put it, EV per ounce is crude. NAV per ounce, picks up all of the things that we've been talking about in the valuation of a project. So no question, there's a lot of value in doing that. But meanwhile, we continue with this exploration and, talk about track records. Here's a isometric 3-dimensional view of our deposit running from 2018 to 2022. You can see the resource in 2018, the blocks shown here in red, and 2020, we're getting more blocks with more drilling. 2022, more blocks with more drilling. And the finding cost at $5 an ounce relative to relative to our market cap, shows that the investment of dollars into this project is yielding benefits, even at our relatively low valuation. And if you think about the takeover valuations for the projects like this, large projects in good jurisdictions, lots of upside for investors, let alone the relative value from an NAV or from a gold price in situ point of view. So this is how we make shareholders money, is by finding more ounces and by putting them into those mine plans that you're talking about. We've been talking about this restart project, but I do want to share with you a couple of images which describe the enthusiasm we have for the subsequent phases of this project. Here's another one of those isometric views, and this is showing in the Joss area where we've got a big, kilometer of strike mineralization in this block model. We're adding to the drilling in this. We're going to have results out from this drilling coming in September. But these are the kinds of grades we're getting in this deposit in the underground. I mean, look at this. 19 grams over 5 meters within 110 meters of 4.3 grams. I mean, this is exciting stuff beyond that heap leach potential that we've been talking about. And this is what is our playing card for, being in the big boys game of large gold deposits in big jurisdictions. Now, we've got a ways to go with that, which is why we're trading at that $8 an ounce today. So there's some de-risking to be done, but that's the scale of the prize. When you can put together something like that, it's pretty compelling.
Hugh, I remember speaking to you almost a year ago when you were first talking about the heap leach potential and the pre-feasibility, or the PEA at the time. I was kind of saying, well, hang on, you've got to kind of demonstrate the scale of this potential, of the scale of the camp. You've got to get some exploration holes into those juicy bits underneath the Joss zone. I may be fickle, but just at this time of the cycle and where we've got to, I'm now thirsty for more de-risking of the heap leach. I mean, you can never win, Hugh. You can never win. I always want something different, and maybe the market does as well.
Well, listen, let me share with you that path, because I agree with you, and I think Tim, you would agree with Merlin here. You've got to have a bit of your cake and eat it too. You've got to be able to show investors that you can deliver return for them from something that's relatively modest risk and that's financeable from our current market cap, which is what Fiore did. Tim's talked about that, taking that operation forward, putting it into production, and then building a growth pipeline behind that. But this is our, broadly speaking, our path to value creation. It's a bit busy, but NPV on the x-axis, so value of the deposit, and then on the y-axis, ounces in the mine plan. Of course, we already have 4 million ounces, but not all of them are in the mine plan yet, because of course we're continuing to grow it. What we do have in the mine plan is about 850,000 ounces in the PEA plan. So the NPV would be somewhere around here at about 100 million. Generating about $50 million of free cash flow a year at $1,750 gold. So basically our market cap every year in free cash flow from just that project. But we want to enhance on that. And so, we're working towards a PFS, ultimately an FS. We've got some opportunities which I've described to you at Haidee, elsewhere where we've got.
Hugh, thank you. This is a really interesting chart. Now I can see in the bottom left-hand side that you've got the heap leach PEA and a step up in value to the PFS feasibility study figure there. But in my experience, quite often the PEA NPV is just as good as the pre-feasibility study, because as you get more certainty, you get higher costs coming in, you've forgotten a few things, all the detail gets improved. And so even though you get some optimization, you also don't really move the needle much. Now, clearly, you might want to, hopefully the pitch will improve as you add ounces, as you study around Haidee. But I'm putting it to you that perhaps the NPV figure won't change that much. Might you agree with that?
This is why we point out some of the opportunities. Yes, we have inflationary headwinds working against us, offset to some degree by the increasing gold price, because the longer the gold price is at a higher level, the more confident the engineers are in using higher gold prices for the valuation purposes. But yes, we are in an inflationary environment. We are seeing costs of inputs going up. Some of that balanced a little bit by the gold price, but that's why we look to opportunities and why we're focused on increasing the resource at Haidee, where we've got near surface oxide opportunities open in both directions. That drilling is really important. I think you've pointed that out. The optimization, just to give you a very particular example, we're assuming a 75% recovery, heap leach recovery from our Haidee material. Now, if we do a column test work, which supports some of the historic recoveries, up north of 80%, and in some cases 90% from historical column test work. If we can reproduce that with modern testing, then we'll have confidence to move the recoveries up on that Arnett material, and that's an optimization that will come right directly to the bottom line. Pit slopes, as we add ounces and tons that are previously considered waste stripping, where we've got more drill data, or where we can steepen slopes because we've got better information around geotechnical information. Those are the kinds of optimization aspects which I think could build a better project. even the sequencing, as you've pointed out, we've got material both at Beartrack in the main area of the project, and then we've got this satellite pit. And as we bring in that satellite pit and optimize its location in the overall mine plan, we can get some optimization in terms of the overall scope of things. And I see opportunities here, and that's why we spelled them out here. We think there's an opportunity to improve on the NPV and the returns for just the heap leach project. And we remember we've got multiple targets across this property position. We're not going to get them all into our PFS, but we'll work to get some of those into our feasibility, and those will be opportunities down the road too that we'll consider in the growth pipeline for the future. So yes, yes, and yes, lots of opportunities to add value to the heap leach restart plan at Beartrack.
Good. Just kind of as I see it, I mean, you were talking about that the NPV in the PEA has got a kind of a value of around 100 million. Presumably that's US, and your market capitalization is or in fact your EV is around 40 million, possibly less if it's US. So you're effectively trading at a 60% discount to your NPV.
More than that, because the correct math is roughly 100 million US of value, roughly 30 million US of market capitalization, and that's just for the ounces that are in the mine plan. So in fact, we're talking about something that's trading at currently a third of NPV, and excludes 3 million ounces of gold in the project, which we'll get those into the mine plan. And I'd like to explain to you some of the right side of that figure as well. But yes, the equation's pretty compelling for investors. Now, it's not going to happen all overnight. It's going to take time to put this together. But that is the path to delivering value for investors. And if we compare ourselves, to some of our peers that have gone through that path, like Marathon, there's a big prize.
Yeah, absolutely. And I think if just looking at the ounces that will fall into the heap leach project, and I know you've got the upside of the kind of the bigger trend at Beartrack, and I know you've got the kind of the million ounce potential off to one side, but just looking at what falls into the heap leach, I think that crucial thing is walking down that discount as you de-risk the project. Instead of having a 70% discount to your NPV, you march it up to a 60% discount and then a 50% discount. And once you're in permitting and you're kind of in the front end engineering design, that discount was probably down at 30%. You're trading at 0.7 of NEV for that project. So really the next step is to kind of get those pre-feasibility numbers out. And that's a real kind of building block of value that you'll be able to demonstrate just for that heap leach project. And of course, as a sidecar, you're gonna keep pulling out the results from Joss and kind of show the upside and the kind of the scale of the project. So I mean, you said earlier that the drilling is ongoing, and so I expect those results to continue. Can you just give me a bit of timeline for the pre-feasibility study, please?
Yeah, so we're presently targeting to get that done here in the next 6 to 12 months. And you're right, that is an important building block. But I've got to bring you back to the bigger picture, Merlin, because of course, you have companies like Great Bear that are being bought for literally billions of dollars with no economics on them. And why is that? It's because the corporate development team scouring the world for good places to mine or looking for big projects that can be meaningful for the long term of the business. So what we don't want to do is get caught with our pants down, narrowly focused on the heap leach restart, which is got lots of value to it and which will deliver a lot of free cash flow, and have somebody come over the transom and recognize value in our project that we have not communicated to investors. So I want to stress, there's 4 million ounces. We've got a whole heck of a lot more. We've got drill results coming out in September. We want to get that message out because our concern is that the smarter corporates out there that are looking to fill their pipelines will see that value before your audience sees it, and they'll miss out on the opportunity. It's my job to make sure we communicate that upside. And we've got an open data room. We've got several corporates in that data room looking at things. And I'm not saying this is, something that transpires in the next 6 months or a year, but I can't leave this conversation without talking about the upside and why that is important for our investors.
Well, you haven't. You've covered it. Tim, do you want to kind of share any final thoughts on kind of how you advise the company as a director on kind of building value? Your kind of personal thoughts on what you give to the board.
Yeah, I mean, I think, one of the things I bring, and I think one of the reasons that you asked me to be on the board, was my experience in the US. I mean, I've gone through this already. Nevada is a slightly different environment, but it still works under the same federal rules and the same process and everything. And we had the same challenges with regulators as we permitted and all the things that, that have to be done along the way. And just that kind of experience in taking we took a company that, again, was a past producer, much like Hugh has in Revival. We looked at it, we reevaluated it, we turned it around, we turned it into a cash flowing asset, and then we got taken out. And I think that process, I mean, it's not exactly identical, but I think that my experience in that process is invaluable. At least I hope it is. And I think, again, going back, that kind of just steady, systematic, checking the boxes, going through the steps, telling the market what you're going to do, and then doing it. That's sort of, I guess, been my advice, and where I'm hopefully adding some value to the board.
Great. Well, thank you very much. Hugh, we've probably got to wrap it up there, but it's been really interesting seeing your having your insights. Thank you very much for preparing the materials, showing how you value the company and the building blocks of value. That's been extremely useful as well. And I look forward to seeing you round the traps, perhaps at conferences in the near future, and catching the news flow as it comes through in the coming months.
Thank you, Merlin. Appreciate the interest.
Thank you.